Hi everyone, this is a technical analysis on USDJPY. Let's start with a fundamental overview first. The USD sold off across the board on Friday following another soft NFP report. The dovish bets on the Fed increased as a result, and the market is now expecting 3 rate cuts by year-end. Moreover, we have also a 10% probability of a 50 bps cut in September, but that will likely happen only if we get a soft CPI report on Thursday. In that case, the greenback will likely weaken further into the FOMC meeting and might finally get us out of the range in USD/JPY pair. Overall, if one zooms out, the US dollar continues to range, although the dovish bets on the Fed keep weighing on the currency. Part of that could be the fact that the bearish positioning on the dollar could be overstretched, and we might be at peak dovish pricing. In fact, if the rate cuts trigger strong economic activity in the next months, the rate cuts in 2026 could be priced out and support the dollar. Nevertheless, the trend is still skewed to the downside, and we might need strong data to reverse it. On the JPY side, we haven't got meaningful changes in the fundamentals. Over the weekend, Japanese PM Shiba resigned, and that weighed on the yen, with the currency gapping lower on Monday open. But as it generally happens with such political stuff, the gap was eventually closed, and the yen returned trading at pre-Ishiba resignation levels. The yen has been rallying mostly on the back of the dovish expectations for the Fed. For more JPY appreciation, we will need weak US data to increase the dovish bets on the Fed, or a series of higher inflation figures for Japan to price in more rate hikes than currently expected. Now the daily chart, we can see that the USD JPY eventually got rejected once again from the major 148.50 resistance zone. The sellers will continue to target this major upward trend line around the 145.50 level, while the buyers will likely step in around this trend line with a defined risk below it to position for a rally into the 151 handle next. On the 4-hour chart, we can see that despite all the important events and data releases we got in August, we've been stuck in this range for over a month. Traders will likely continue to play this range by buying at support and selling at resistance until we get a breakout on either side. On the 1-hour chart, we can see that we have this minor downward trend line defining the bearish momentum on this time frame. The sellers will likely continue to lean on the trend line to keep pushing into new lows, while the buyers will look for a break higher to position for a rally into the 148.50 resistance. These red lines define the average daily range for today. For the upcoming catalysts, tomorrow we get the US PPI report. On Thursday we get the US CPI report and the latest US jobless claims figures. And on Friday we conclude the week with the University of Michigan Consumer Sentiment Report.